Think Realty Nation, it's your host, Avi Golhar. Welcome to the Think Realty podcast. If you are interested in learning what the trends are going to be in 2021, my guest today, I know he has the crystal ball of crystal balls. He's been able to successfully predict every single market in every single state in the entire country for the last 145 years, but he still looks like he's 25 years old. Jeff Tesch with RCN Capital will be joining us today, but before we get to him and the conversation there and where the market's going to be, I want to give a huge shout out to today's sponsor, Norada Real Estate Investments, your premier source for cash flow investment property. Visit www.noradarealestate.com. So without any further ado, Jeff, welcome to the show, man. Good to see you again. Happy New Year.
Great to be here, Avi. Always a pleasure to share information with you and your audience. Happy 2021.
Yes, happy 2021. As much as I don't want to talk about 2020, I do want to pick your brain a little bit about it, and then how what happened in 2020 is maybe influencing some of what's happening in 2021, and to get to some of the market conditions and what your expectations are of this year. But before we get there, give us a little background on who you are, what you do, and give us a little maybe minute on RCN.
Sure, absolutely. So, hello, everybody. Jeffrey Tesch, CEO of RCN Capital. We are a nationwide lender that provides capital to real estate investors across the nation. A little bit about our company. We're a family-owned company that started in 2010, really as a way to professionalize short-term bridge lending to investors who are buying distressed assets. We started here in Connecticut on the East Coast, and our goal was to take hard money or private money and professionalize it, take it out of the shadows and turn it into a legitimate commercial product that investors eventually from coast to coast could really interact with the lender and be treated with the highest ethical standards that we as investors who started this company expected from our lenders. And that's where we are today, coast to coast, closing in on 150 employees. Really proud of the company we've built, originating short-term bridge loans for acquisition and funding of rehab, as well as long-term rental loans, which is a market we'll talk about today, Avi, just absolutely exploding, putting 30-year debt on rental products. And I'll tell you, a product last year that took a bit of a pause, but is back, which is multifamily rehab lending. So apartment buildings, people buying distressed apartment buildings, repairing them, and putting them back into the marketplace. So we've been providing debt, not only for the acquisition, but the rehab of those multifamily apartment buildings across the United States. A little bit about us, and great to be back with you.
Excellent. Well, thank you for the intro, and thank you for a little bit of that background. I hate talking about 2020. I think everybody does at this point. It's laughable, but I think we also have to give a little bit of credence to it. March 9th through March 13th was that first week. I was supposed to be in Portugal and decided not to, and thankfully we didn't go. Otherwise, we would have had a really hard time coming back into the U.S. But that week, I remember very specifically, I'm like, oh boy, I wonder what's going to happen. And then almost overnight, lenders vanished. And we were back to 2011, where rates were hovering between 12, 13, 14% interest, 3 or 4 points up front. Has that subdued a little bit? Have rates kind of returned back to the 7.5, 8s, 9s now?
Yeah, absolutely. And like you, I was already embarked on what was going to be a very, very busy speaking circuit. I get invited to a lot of mortgage conventions to speak on private lending. And I was actually in Orange County, California on March 6th, speaking at a residential mortgage broker conference, packed, just absolutely overflowing with folks who were getting ramped up for 2020. And I was there, and COVID was on the radar, but everybody wasn't quite sure what was happening. But everyone was excited for where the mortgage business was going, and It turned out to be a great event. And then within a week, everything changed. And when I say everything changed, and basically what that meant for most lenders that lend to investors, many of our capital sources that we rely on basically said, we're not going to be extending that credit to you that we extend to our borrowers. Now, we're a family-owned company. We have our own capital. We have our own ability to fund short-term debt. But all of the long-term and the ability to be able to charge those low rates to the customers comes through leverage. And when that leverage went away for a period of time, it not only caused us to stop lending, it also caused the rates to increase when we resumed lending. While we continued to make a few loans to customers that we could, it was decimating. And that lasted for nearly 3 months. But what did happen was we didn't lay anybody off. We kept the company together and we worked. We put our nose to the grindstone to come out stronger than ever. And when we resumed lending in June, we were rewarded for not only being transparent with our customers, letting them know what was going on and saying, hey, we just can't lend right now. But when we resumed, that transparency really paid off and we were able to hit the ground running, and we haven't looked back. So to answer your question, yes, rates and leverages have returned for a while now to back where they were pre-March. Rates are in the 7/8 on bridge with leverages up to 90% of acquisition and 100% of rehab funding. And amazingly enough, the long-term debt on the rental market, which we'll talk about today, has returned into the fours.
Wow.
For that 30-year debt on non-owner occupied investment properties.
So let's take the conversation there. Rental loans and rentals for investors specifically, those that have opened their eyes to, wait a minute, I want to actually build a portfolio instead of put an asset on my books and then take the asset off my books and not build long-term wealth. For them, they've started to wake up and smell the roses and think, okay, wait a minute, maybe I do need to buy and hold a little portfolio. And it's a really good thing. What are some of the trends you're seeing there in terms of the product, and then maybe in terms of some of the areas in the country where you're lending the most amount of capital because investors are finding opportunities to acquire?
Sure. So let me give you some data that we see here at RCN Capital. So pre-pandemic, we were originating approximately 60% of our monthly loan production in the short-term bridge marketplace, right? So 40-60, 40 going to rental, 60 going to short-term bridge. That had been growing for a while, the rental portion of originations. Why? Well, it's a lot of the anecdotal information that I'm sure many investors see across the country, which is most homes are continuing to appreciate and investors want to participate in that, not only for today, but really to build generational wealth. That's what we keep hearing from our repeat customers is, I can take the money off the table today and make a nice profit, but I know if I put a tenant in here, I'm going to participate in the appreciation that we're seeing, which we were seeing pre-pandemic, by the way. And the pandemic is only throwing gasoline on the fire when it comes to an appreciation standpoint. Matter of fact, I think the National Realtor Association, as well as Case Shiller, reported almost 11% aggregate year-over-year appreciation for single-family homes in the month of November. So going back to 2019 to 2020, 11%, Avi. Amazing numbers.
That's phenomenal.
And when you look at those numbers from an investor's standpoint, they want in on that. They want in on it for the long haul.
Yeah.
So that's what we've been seeing. But the flip at RCN has been 40-60. Now, since July, it's 60-40 rental. It's been a complete transformation on our end where investors now have just upped their game. And now we're going 60% rental, 40% short-term bridge. And it's ravenous.
And it's
just
working.
ravenous.
Yeah, and it's working for RCN. What areas of the country, if I were to focus on, where do you suggest I go? Major cities? Are you maybe secondary markets, tertiary markets, populations of less than 1 million? What's
Sure.
working?
Yeah, so a couple trends are going on here. The first trend that many of your investor customers today should understand is the more sophisticated investors, which often find their homes to be on the East or West Coast, a little bit of Texas as well. But most of the investors who are aggregating large numbers of properties, East, West Coast, are buying properties not within 100 miles of their home. So where are they finding those opportunities today? And we see this data aggregated over and over again in RCN. Florida, number one for us at least. We're seeing out-of-state investors buying multiple properties to build out portfolios in the state of Florida. Next up, Georgia. After that, believe it or not, Alabama. Birmingham is absolutely hot as all get out right now. Tremendous. Rural Illinois, outside of Cook County, there's a great deal of aggregation going on with single-family homes. Oklahoma, especially in and around Oklahoma City and Tulsa. New Jersey, once you get away from the city, suburban flight is a real thing, and people are renting homes in New Jersey, and there's a real opportunity for investors there, and as well as Maryland and Delaware. I mean, these are just some of the areas that we're seeing across the country, but investors have figured out using technology today that they don't need to live near the homes that they're buying, and they have the ability to aggregate homes with a much higher return on equity in some of these markets that I just described to you, Avi.
So maybe you can work from home, but you could also invest from home. Maybe that's a new hashtag campaign, right? From a marketing perspective, that could be kind of interesting.
Yeah.
From a 2021 prediction perspective, where do you think we're going to be toward the end of the year for investors and lenders alike?
Yeah, I mean, well, the first thing everyone thinks about is what's happening today from a real estate inventory sort of perspective, right? So, and I've been saying this for a while, and I'm going to say it again. There was not enough homes pre-pandemic for the demand. And all you have to do is look at the charts for new construction versus demand in the United States ever since the Great Recession back in 2008. The new construction has not caught up with the demand for single family houses. Now we throw the pandemic on there, and it's only made the situation more dire for the amount of demand for single family houses across the United States. So, well documented, more demand than there is supply. Okay, so what does that mean for prices? Well, as I shared with you, we're up nearly 11% year over year. How much more can we see in calendar year 2021? Some of that's going to be dictated by the pandemic and how quickly we can get the vaccine out and how quickly we can get that unemployment rate down. That will only further spur the demand. But what investors really like to talk about is they like to talk about the forbearance that the government agencies that guarantee the single family loans have put in place for homeowners. So a couple numbers, right? So right now there's about 2.2 million homes in forbearance. That means they've opted not to pay. They're going to have the opportunity to put that payment on the end of their loan and resume those payments, assuming they can, and they have the ability at the end of their forbearance period. Our guess at RCN Capital is the GSEs are going to extend out that forbearance. It was originally supposed to be a 12-month. My guess here is we're going to see that extended. Now, what investors are thinking about is, well, when that comes to an end, there is just going to be a tremendous opportunity for foreclosures. There's a couple reasons we don't see that happen. And the first one is the amount of equity that has been built up in homes across the United States, Avi. Like we've discussed today, 11% year over year, and that's a national average. But there's other states where it's much higher. Let me throw out some states: Utah, Colorado, Arizona, California, Georgia, Texas. All of these states have tremendous amounts of equity in their homes. We just don't see the foreclosure crisis being anything remotely like the last go around. Will there be some? And it's so unfortunate. It is going to take place. But we don't believe that the end of the forbearance period that will be coming at some point in 2021 is going to lead to an influx of homes coming into the marketplace. That's just what we see, Avi.
That's fair, because I was thinking about how the logistics of that would work, right? Let's say a bank has a portfolio of 100 homes, and they said, okay, you can't pay the note, so we're going to foreclose. Even if they did that, they would still be able to make their money back in droves. So at this point, it's more of an asset play for them, and I don't want to say it, but maybe they're thinking, well, okay, this isn't such a bad thing, because we'll end up with an asset that's worth more if we decide to sell. If we can get control of it through foreclosure and then end up selling it, we'll make more than we would long term anyway on a note that was paying. So it's
and there will be some folks that just throw in the towel.
Sure.
But at the end of the day, if you have equity in your home and the GSEs have a program for you to reinstate, most likely you're either going to do that or you're going to sell it and take the money yourself.
Yep.
So I mean, this is where we think we're going.
I would like to see some of those even become reperforming too. That would be a very interesting turnaround. And so for that reason, I'm kind of with you on that. I don't think the end of the moratoriums is going to create this onslaught of new investor activity where you're going to have folks coming out of the woodwork to start buying homes because it was a 2009 feel. I'm just not feeling that. I'm not seeing that at all.
Yeah, agreed. And the typical states who have judicial foreclosure process, when I say typical, I'm referring to New York, New Jersey, Massachusetts, Illinois, Connecticut, all of these Northeast and upper Midwest states that tend to put the foreclosure process through a judicial process. It's going to be a long road before those homes hit the market.
Yeah. So that being said, what's RCN's focus for 2021? Is there going to be a new construction product that you guys are enhancing? Maybe that could be an interesting play, given what you said about the demand for our homes. It always has been, and it's going to be. We're just not even there yet, but we're not building enough for what the American consumer needs in this country. We're lagging behind pretty significantly from an inventory perspective. What are your plans this year?
Yeah, absolutely. So we believe from an origination standpoint that rental will still continue to grab market share internally from us, right? So we're at the 60-40 now. We think it's probably going to continue to tick up as we go into quarter two. Multifamily, it has been picking up significantly quarter four of 20. It was super quiet the majority of the year, but there has been some repositioning of multifamily now, and folks are looking to renovate those apartments and using our products to be able to do that. You mentioned new construction. We have a new construction product for repeat customers now on an infill perspective, meaning existing lots, existing roads. We expect to roll out a much broader product in quarter two of this year to new investors that haven't previously worked with RCN Capital. The demand is there. and we're finalizing capital resources for that now, and we're very excited about that. And then eventually, later in the year, we're expecting to be able to roll out a long-term debt on multifamily as well. As I'll tell you, the non-owner occupied, which is super interesting because let me throw out another number for you. So 67.9% in Q2 of 2020, the highest home ownership rate in 12 years. But yet on the rental side, it's busier than ever on single family. So it just goes to show you, it is a bridge between the two. People do like owning their own home, but the rental on the single family has really grabbed a significant chunk of the non-owner occupied space. And we expect it to continue, Avi.
What I'm seeing here in Atlanta, I make it a habit of always driving. I'm always driving around to see what's going on. And when there are new townhome complexes that are being built, and the moment that they're being put up, you'll have a few of them that are sold and a few of them that are rented by the builder. Why is that?
Yeah. So what the builder's doing is they're taking their chips off the table. And then what they're planning on doing is taking the money that they made on the construction and booking that long-term into a long-term return to help build their business. It's no different than the flipper that's still flipping and also holding some product on the side. He's just doing it, he or she is doing it as a builder. And then they continue to rent them and they build out themselves a nice income stream for the long term. Smart play.
Super, super smart. I'm seeing that almost everywhere in Atlanta. It's so interesting to see. Last question for you, Jeff. Single family or multifamily? As an investor, what in the eyes of RCN Capital, if you were to take yourself and put yourself in the shoes of a borrower of RCN Capital, where do you see that playing out? Does that depend on your investing personality, or are you a proponent of one or the other?
Yeah. So, the multifamily was always seen as the simpler play, right? You have one building where you can put one manager in charge of that building under one roof and collect X number of rents, right? That was always how it was understood. But what's happened over the past 3 or 4 years is technology in the marketplace has now enabled folks to be able to spread their own resources without necessarily having to hire managers. There's any number of aggregators out there who will manage these properties for you, or you can do it in-house using technology. We're a big fan of building out rental portfolios today using the technology that has been put into place, such as, remote keyless entry, such as remote cameras to be able to monitor if you're aggregating multiple homes in multiple areas. There's so many things that we see, and we haven't even talked today about what we're seeing for build to rent and building whole communities of rental properties, which, where you are in Atlanta, this is a trend that's been going on for a few years where large investors are coming in and building entire communities of single family houses. It's not changing, and we believe that's where the future is.
Jeff, it's always an inspiring conversation filled with data, so I certainly appreciate the time. We'll have to have you back at the end of the first quarter, beginning second quarter, to pick your brain a little bit to see if your opinion has changed. I don't think it's going to change, but you never know. You never know. Maybe there's some delay in the vaccine or something that will cause your brain to say, okay, you know what, maybe what I said in January needs to be extended out a little bit. But always a pleasure connecting with you, man. If you are an investor and you're looking to get capital, and you're looking for smart capital, check out rcncapital.com. And when you do have a chance to say hey to Jeff, definitely let him know I said hey too. So, Jeff, thanks a lot. I certainly appreciate the time, man.
My pleasure, Avi. Always great joining you. Thanks to everybody joining today. I appreciate it.
Think Realty Nation, this next segment is brought to you by AaronBChapman.com. Bypass all the overcomplications of this common suit and tie mortgage guy and connect with Aaron Chapman and his team of real estate investment finance experts at Security National Mortgage. No fluff, no complicated industry speak, just brutally direct action. Visit aaronbchapman.com today for more information. So, Bruce McNillage wrote an article for thinkrealty.com titled Managing Costs and Build to Rent. And if you don't know Bruce, he's one of the sharpest guys that I know in the build to rent space. And he wrote this article, and it's almost like a foreshadowing, I suppose. If you are looking at doing build to rent, there are a couple of things you need to consider. First of all, it's the strategy. You're not building to sell, right? So you can't, when you have a build to sell model, you pass on any premiums that you would have to pay in cost overruns to the buyer, to the retail buyer. But on a build to rent model, you have to really be careful of what you're putting into the property, because as the cost of labor is increasing, the cost of materials is increased, that is ultimately going to affect your bottom line. The speed to execution here is going to be important too. Depending on your financing, you might be carrying this project for months on end without a whole lot of work being done. And guess what that does? That adds to your cost and it adds to your bottom. It takes away from your net profit, your cash flow, your bottom line on a regular basis. So managing both cost and the speed to execution to getting this done is significant. It's like super hyper important. He brings up a couple of additional points in this article, which I want you to read. One of which is relationships for your labor pool. It's one thing to have labor. It's another thing to have good labor. And I think it's another thing to have good labor refer other folks that can also be a part of that good labor pool. If something happens to one guy or one gal, you never know. You just never know. So you want somebody else as a backup. And what Bruce is saying here makes sense. You know, quote, as they say, good help is hard to find. If you have a good crew and can give them multiple jobs throughout the year, they'll be much more likely to work with you on price. If you have bad relationships with your labor pool and they're constantly on the hunt for new people, costs will go up and eventually quality will likely go down. I'm sure you've experienced this even in your own market. You'll have a great crew and, well, you might not treat them you might not treat them right a couple weeks in a row, and now they're looking for other opportunities, and they found a new investor. They start taking advantage of the new investor. Yeah, I said it, and you know it's true. And all of a sudden, the quality goes down, the price goes up, and you're stuck wondering what the heck happened. But the fault was yours. So really pay attention to who you're bringing on your team, interview them, and treat them well. At the end of the day, that's what matters, especially for a build-to-rent strategy. Think Realty Nation, that's the time that we have today. You want to get in touch, go to thinkrealty.com. A huge shout out to today's sponsor, Marco Santorelli and Narada Real Estate Investments. Your premier source for cash flow investment property is Narada Real Estate Investments. Check out naradarealestate.com. We're here for you at Think Realty. Check out the previous shows, the podcasts, even the radio shows from many, many years ago. That's right, hosted by yours truly. If you've got any questions, I'm here to connect you with the right people. So drop me a line either anywhere on LinkedIn, either on social, Facebook, LinkedIn, Twitter, Insta, whatever. Come find me, and I'll make sure you're connected to the right resource that you need. Until next time, happy investing.